The one piece of advice I would say is don't wait too long to start your capital raise because it's going to take longer than you think. Make sure you have a budget for that capital raise because it's not going to be free. You have to raise your visibility. You have to, be on social media. Just make sure that you are aware of your company's profile publicly.
You can't replace part of the brain. Like,
you treat them the same.
Source of truth for the medtech industry.
Coexists with the puppets.
Robot understands things automatically.
Number one show in the medtech industry.
So Stryker got ahead of that and changed in the $90 billion company. They had help up high, a lot of things.
State of medtech with your host, Omar and Khateeb.
Hey everybody, welcome back to the show. If you're a founder, this is going to be a really important episode. You're going to want to bookmark it, probably review it a few times. It's really rare when you find somebody who has been on both sides of the pond in the sense of being an entrepreneur and then an investment banker. So Colleen Gray is Senior Vice President at US Capital. We met at the beautiful LSI Summit in Dana Point. Over dinner through our good friend and mutual friend, Chris Prentice. And what caught my attention was that, she was formerly an entrepreneur and now an investment banker. And so I just felt like I had to have her on the show to talk about not only that journey, but more importantly, new ways of raising capital. One thing that I was able to pull from the HSBC's funding report, thanks to John Norris and his great team there, is that from 2023 to 2024, the amount of venture dollars that went into healthcare as a whole rose from, I think, 43 billion to 57 billion. So a sizable amount, I think close to 30%. But the number of deals that got funded, I think only was an increase by 2 or 3%. So all that to say, finding capital is become a lot harder. And I think it's more important today than ever for entrepreneurs to understand what different vehicles they have access to do that. That being said, Colleen, thank you so much for coming on the show. How are you doing today?
I'm great. And thank you, Omar, for asking me to be on the show. I'm really looking forward to it.
Absolutely. So before we, I guess, get down to brass tacks, as they say, give us a little background on yourself. Like, formerly you're an entrepreneur. So like, what kind of company did you start? Give us a little background on that.
Sure. Omar, what's really served me well is I started my career and my educational background is in finance and accounting. So it's good baseline for what I'm doing now. But I worked for some really large companies early in my career in the technology industry and spent a lot of time focused on data storage. I always had, an interest in operations. So I was able to expand my responsibilities beyond, CFO roles and that type of thing into more of the manufacturing space at the technology company that I was with. And then that company was acquired by IBM. It was a great outcome. It was a public company. We did a successful public offering before IBM acquired us. But I will say my next opportunity was the start of my entrepreneurship. I was a co-founder in one of the first cloud-based storage companies. It was too early to market, but I learned a lot. It was in 2000. We ramped up revenue really quickly, but then it just wasn't the cost basis of connectivity and storage at that point in time was too high, and also had to go through the .com bust, which was a terrible experience in one sense. But, learned a ton from what it takes to found a company. We raised a lot of capital there, both debt and equity. So it was a great experience overall. And, from there, I went to kind of a turnaround situation in a data storage company. But that's where I met the investors who recruited me into orthopedics. So it was a kind of fortuitous meeting there. That didn't last long, but I joined Consensus Orthopedics as CEO. And that was a turnaround situation and a learning situation for me. I had to learn a whole new industry, and it was a great experience. We built that company to over 20 million in revenue and sold it to an Indian hospital system. So that was a pretty interesting transaction. We got it done, kind of still in the middle of COVID. And then we didn't sell the entire company. We kept a technology that we had incubated, which was a Medtech technology, a patient monitoring medical device that was done through a wearable. And it was monitoring patients pre and post op, mostly musculoskeletal procedures. And we sold that company to a family office in the summer of 2023, which is shortly after that, I ended up joining US Capital. And, I was a former client of US Capital's. I worked with them for several years when I was CEO of the medical device company. They assisted me in accessing better lines of credit. And the last transaction they helped with was a equity raise. So I know the company really well. I know the founder really well, who's the current CEO still. And it was just a good fit.
Fantastic. I love that. And, capital, there's so many nuances of finance that I don't understand. But the one thing I do know as an entrepreneur is that, for entrepreneurs and small business owners, it's important to have like smaller banks available to us, just because they're going to be a lot more flexible in terms of how they lend money, what they can do, etc. Versus me going to like a larger institutional bank is just not going to make sense. So like on that note, like let me launch into it. So, if we look at how the environment is today, right, the current capital raise environment is particularly challenging. There's a significant amount of volatility. The political environment doesn't help. And then also we're seeing longer timelines. So you put all that together and securing first institutional rounds has become a lot more difficult. And, in our space, like it costs money to take these products to market. Can you kind of elaborate on like why we're seeing this right now, and like what can founders think about doing to get access to that capital? Because like I was just talking to a founder earlier who had a fantastic technology. Actually, it's a clinician who's a founder. So great founder, great tech, all these things. And a lot of the institutional investors said the same thing, which is like, great stuff, can't do it now. Come to us like at the next round. So like, what do you do?
Yeah, I think first of all, there are so many companies in need of capital right now at various stages, whether it's seed, A, B, C. But, standing out from the crowd is so important. And, really got to capture the attention of these investors from the first meeting. And, while tech is important, I think one of the things that we focus on at US Capital is working with our clients to make sure that their messaging to investors resonates. Yes, you can talk about the tech, but really talk about what the investors really need to hear from you, which is you understand your market, you understand who's going to buy your product, how you're going to get paid for it, you've got control of the capital you have raised. It's so important to be able to show what you've achieved with the capital you already raised. Because that's, right now when there's so many companies competing for that scarce dollar, investors want to know that you know how to spend money and accomplish things. So I think, messaging that in your pitch deck and raising the right amount of money and, knowing how to articulate why it's the right amount of money are some of the key things that founders can do in every communication with an investor.
I think that's a great point. It's the first time that I've heard somebody frame it that way, which is aside, I'm as a guy who runs a marketing agency, getting attention is like step one. If you can't get somebody's attention, you can't get them to pay you money, right?
Right.
But I think the other side of it is actually framing and coming up with, how did you come up with that amount of money that you need, and like how are you going to use it? And I think a lot of founders, sort of, jerry rig and skate by, and they just kind of come up with some random number. But it feels like that's the wrong way to go, because it could be that you actually need less money, and even if, let's say, maybe you need more, structuring how you're going to spend that money is going to be important based on like the valuation you're going to get, correct?
Right. And we know valuations are really under pressure.
Yeah, 100%. What, when you've worked with clients in this sense, like what What are some of the most common mistakes that you see founders making?
I think the most common mistakes we see, a lot of founders are technologists. And so we see founders that can articulate the technology very well, but they're not necessarily engaging speakers. So, it doesn't really resonate with investors to the extent it could if they were more engaging speakers. So I think practicing your pitch to if you've got some investors on board already and getting some critique can help tremendously. And actually, we do that at US Capital. We will work with founders to help them, really tune their pitch deck and all the investor materials. And we get all of our bankers on a presentation with the founders and we have them present. And then we do a critique. And I think just practicing and listening to feedback is really important.
Let me ask you a question again. Just I wanted to be very direct and let the audience know this is not a US Capital sponsored episode, but I'm very interested because I didn't hear about US Capital until I met Colleen, and I think it's important to understand this. So can you give me a stereotypical persona that would come to US Capital? At what would it be a founder at a seed stage, at a Series A? What does that person look like? How do they first start using US Capital so that they get access to your expertise? And then again, some of this financial modeling is really complicated. You can't, I love AI, but you can't chat GPT that, So how does somebody know, oh yeah, I'm actually at a stage and I fit the mold of somebody who could be a good customer to US Cap?
So I talk to, I don't know, many people every week, probably up to 30, 40 founders a week. And, I will talk with just about anyone to understand, what their stage is, if they're seed level, pre-seed, Series A, whatever the case may be. But what works best, I think, for founders, if they're pre-seed or seed, they really need to focus on their network, and I would say industry insiders that understand what they're doing to raise that really early capital. We tend to work with companies, you could say later seed in some ways, depending on the sector. For instance, biotech, a seed round for a biotech can be, $10 million. So we'll work with companies when they're in the market for about a $5 million raise. And one of the things that we do is we get to know our clients and their business really well. And we collaborate with them on what type of raise, how much should they raise. We collect enough information up front before we're even engaged so that we can really add some value, even if the client decides not to go with us. We've built a relationship there, and hopefully they'll come back to us at a later stage.
Got it. So you mentioned, so the key number there is when they're getting ready to raise at least 5 million. And it doesn't matter whether that's a seed or a Series A or anything.
Doesn't really matter so much. We like to see companies that already have raised, let's say 2 to 3 million. So there's, they've progressed and have, kind of an operating entity. They're not really just an idea and a founder, right? It has to be a little bit more substantial than that.
So a lot of founders, before they get to you or even get to me, on the marketing side, they've raised at least anywhere from $200,000 to, let's say, $1 million or $2 million, right? Some of the clinician founders, like the one that I just had on earlier, did a $3 million friends and family, right? So great. You mentioned how important it is to show investors how you've used money in the past. In the pre-seed stage, in that range of, let's say, $200K to $1 million, I think that's most medtech companies fall into. Rather than talk about how to use it, let's talk about what are the wrong ways to use that money, where if you saw it and you're oh, that's really going to be tough to explain to investors. Walk us through that.
So we sometimes see founders who are unrealistic as to how much they should burn on salaries, and don't necessarily do a good job of just paying for the time they need from certain specialties. For instance, you really can't afford a full-time CFO when you're in a seed stage. So, taking advantage of fractional CFOs, and other types of services can save you just so much money. And, whether or not you can get people to work for equity and a very small salary, just being creative on how you're going to attack keeping salaries low while you're going through the seed stage. I think another thing that companies lose sight of is, make sure you understand that your product, if can be reimbursed. So, money you spent on investigating how your product will be reimbursed and just confirming that is money well spent.
So
I
would
would
you
spend.
recommend like engaging like a CRO, for example?
Well, I don't know if about a CRO. It depends on the product, but if it's a really unique product, you might do some of your own research first, or I don't know if you can afford a CRO at the seed stage, but there are plenty independent contractors out there that have that subject matter expertise, and they're not too hard to find. If you find them, you can usually get them for a much more reasonable price than if you hire a full-fledged CRO.
Yeah, I think it's a good point. I think also like there's a lot of really great tools out there. I mean, I think if I recommend founders to use two different ones. One is on the commercial intelligence side, where you can see like uh, procedure volume for specific clinicians, etc. AlphaSophia is fantastic. Um, Small plug, you guys can go to alphasophia.com/Omar to get like a free demo. The other side, which I use all the time, is Compass by LSI, which is incredibly affordable. And you can see a lot of like worldwide procedure volumes, market reports, etc. And I think it's really important to understand that, because I think a lot of founders, they'll think of a great like technology to solve a problem, but you want to make sure that you're solving a sizable problem and you have a way of getting paid for solving that.
Right, right. I think the other mistake founders make sometimes is they've got a great tech, but they're in search of a problem for it. And, that is not ever going to fly with investors. You really need to solve a problem. It can't just be, well, it's as good as XYZ solution. So it's a good alternative. That's just not compelling enough in today's environment.
Hey everybody, quick commercial break. If you're an entrepreneur or perhaps work in a venture capital firm, you're going to want to listen to this. So, since publishing their very first market report in 2006, LSI's market intelligence has been pretty much trusted by the world's top medtech, investment, and professional services organizations to guide everything from investment decisions to commercial strategy and corporate development. Now, LSI launched Compass, which is a proprietary discovery engine for identifying medtech startups, deal trends, and market opportunities. And the best part is that it's available at a price that pretty much works for all. It's amazing how extremely affordable this is. And with profiles of over 6,500 private startups, which contain proprietary content on fundraising, traction, and more, and deals from around the industry updated daily by trusted market analysts, you can be sure that you're identifying your next sales target, fund returner, or competitor first. Me personally, I've actually used Compass right here on this show to do live research on companies, market growth rates, and worldwide sales volumes. And it's been a game changer. Plus, even on my own spare time, anytime I have an interest in a company or a certain market, maybe I want to look up procedure volumes, I just log into Compass and it's right there at my fingertips. And again, it's the latest and greatest data. If you want to learn more and get access today, go to ls-intel.com/data today. That's LS as in life science -intel.com/data today. Now let's get back to the episode. A good friend of mine and guest of the pod, Bruce Cleveland, who's a venture capitalist, he kind of coined the idea around market engineering, made this like very strong point, because, in Silicon Valley, we hear about product market fit all the time, but it's actually wrong. And that's, you pointed that out, which is like developing a product and trying to find a market to fit it is the wrong thing to do. You need to do it the other way around, which is like, you need to look for the market and then fit a product to that, because then you're designing around a problem, and then you can decide like, oh, this is actually not a big enough problem and the pain's not big enough. I need to find something else. I think that's a much better way to go,
Yeah. And I think other things that investors look for is if a company is a little bit later than seed or A, have you done a good job of looking at other types of funding solutions. Like if you are already generating revenue, look at an asset-based line of credit. Look at other things that help you along the way that aren't dilutive.
Yeah, I think that's really important. I think it's tough sometimes with medtech just because you have these regulatory hurdles and to get to the point of generating revenue is tough. That being said, I think it's even more important to understand, the financial engineering behind how much you need to raise, how you're going to use the money, get to market and actually start generating revenue. Because you start doing that, then, the benefit of getting a line of credit is you don't dilute yourself and, your existing investors are going to be much happier with that.
Yeah, I think the other mistake that founders make is being too optimistic when they put their financial forecasts together, and I think that doesn't serve anyone well. In today's environment for capital raise, investors want to get to know founders for a few months at least before they actually start writing checks. So I always, when I'm speaking to management teams, I always tell them, let's identify some milestones that you can put into your forecast that you're going to actually meet while you're talking to these investors. So maybe they're 1 month out, 2 months out, but it starts to show some momentum and build some confidence that you can do what you say you can do.
I love that idea. That's the first time I've actually heard that, but that's such a good point, which is putting together. So would you say like when you have those milestones, like you talk to an investor, do you mention those milestones?
Oh,
And
yeah.
okay. So that's really interesting. So like what would be some examples of like some milestones that can be achieved within like 6 to 9 months that would be a good signal to an investor?
Well, if you have, for instance, a checkpoint coming up that, okay, I'm filing my 510K or whatever regulatory process you're going through on, X date, that you do in fact meet that. You can at least file it. I mean, that's something in your control. And, other things I think if you're a little bit further along would be, I'm about to close some business with XYZ hospital. And if you're confident enough in that and it's in your revenue forecast, then I think that's something you highlight. And then you're able to report to the investor, guess what? That deal closed and we're doing our first cases there currently. So,
I love
you
I love
really got
that.
to think through that a lot, but I think those are a couple of examples of what you can do.
Yeah, and I think what's interesting about that approach is you're essentially proving the investor that what you say is going to happen ends up happening. I think
Yes.
that's like, I think like I can't remember who it was. I'll have to I'll remember who, but somebody said about like being a public CEO that essentially the skill set of being a public CEO is that you essentially have to predict the future and then you have to make it happen. And
Right.
I think that's an interesting way of putting, which is coming up with milestones and showing the investor that you can make promises and keep those promises.
Yes, and I think too, just kind of from a longer term perspective, if you're raising millions of dollars, how you're going to deploy those and what you achieve with that, and I think those are the messages that investors want to hear. Besides, certainly they want to understand your tech and the problem it's solving, but really, I think I've heard this my whole career that the check writers are really investing in the management team as much as they are the tech.
So let me dig into that a little bit. I completely agree, which is a lot of people want to bet on the jockey and not the horse, right?
Mhm.
But what if you're a first time founder? What do you do then?
Well, I think if you're a first time founder, one of the best things you can do is add a co founder that has a track record that brings, maybe some
I'm gonna
exit
challenge you a little. What
to the
if you
table.
can't get you have a co-founder but they don't have that experience? What's the best? I mean, I have a thought here, but like I want to hear you first.
Well, you know what I would suggest? I would suggest that they have really thought through and can articulate, here's the problem I'm solving, here's why my tech is going to work, here's what it does, and this is why I need how many millions of dollars I'm asking for. So if they have the rest of the story that can resonate with an investor, then I think they can overcome that.
I agree. And then you had mentioned it earlier about the power of being able to storytell, right? And I
Yes.
think, and I want to dig into that just from my perspective on as an agency owner, is that I think your ability to communicate with a lot of conviction and energy and enthusiasm is so important, because I think similar to, I I wonder, because you've done this a lot more than I have. I feel like when you're a first time founder and an entrepreneur, it's in a weird way similar to coming out of college and trying to get your first job, which is nobody's hiring you for your experience. And so you have to somehow convey to them this image of you in the future, of who you can be for that person. And I think it's the same thing with like being a first time founder and pitching an investor. Would you agree with that?
I totally agree with that. I think storytelling and weaving that story throughout your pitch, in ways that, is consistent with the problem you're solving, is like, why did you found the company? Where did that drive come from? What drew you to this solution? I think all of those things are important, even if you are a serial entrepreneur, but certainly if it's a first time, I think that it really engages the investors to hear that type of story that really can, talk to them more about why you're so enthusiastic, because that's what they need to see. They need to see that you've got the grit to stay with a particular solution.
Yeah, I agree with you on that. And like just as an example, I gotta give a shout out to somebody. There's this founder, Moises Barbera Ramos, who I think is, I don't know, I think he's like 24, 25 years old, but he delivered, I think, the greatest, most energizing pitch I've ever seen in a long time at LSI. He's the founder. I gotta give him a shout out, of Drill Surgeries, and this guy had like the Steve Jobs level energy on stage, and it was and I kind of forgot that he's so young and he's a first time founder, but I think that level of conviction, and I think that goes back to not just a storytelling, but also having a conviction on how much you need to raise, why you're raising that much, what you're going to do with the money. I think that just like inspiring that level of confidence in investors is like so important.
Yeah, I mean, if the founder isn't confident and doesn't, radiate that confidence and, you know, really telling the investor, I've done my homework. I am confident about this. I know what to do.
Yeah, and I think you kind of hit on it earlier, which is inspiring that confidence that I think maybe, and I wonder if you see this as well, like with technical founders, they rely way too much on the product to sell itself and to get the investment, when in reality, it's like more so them, because like all these companies before they're making money, they're all PowerPoint companies. They're not exactly spreadsheet companies where you can sit down and say, oh yeah, this is gonna be a great investment.
Yeah, one of the things that investors are going to do is they're going to want to really exercise your financial model. And the biggest piece of that, the hardest to put together and the most unpredictable, is your sales model. How you predict, how many cases, how many, times per month, how many customers it takes to develop that revenue run rate is going to get a lot of eyeballs on it. And so that is the most important part of the financial model, and also in predicting the amount of capital you need.
Yeah, and I think like even 5 years ago, Colleen, it was hard to do that. But now, like with generative AI, LLMs, all these things, it's so easy to use some, like a combination of platforms. You say Compass, you can use AlphaSophia. There's a new company I found called Repprep.ai that essentially pulls all this information on a physician and tells you, based on your product that you have, what's the likelihood that they are going to use your product based on their procedure volume. So anyways, I think it's so much easier to model that out and say like, yeah, like, conservatively speaking, we think we can get this much percentage of the market this fast, etc. Like, I don't think there's no need to guess. And I think, would you say it's better almost to be a little bit more conservative on those estimations?
Yes, definitely. I think it always pays to be more conservative. It's better to be to outperform your revenue forecast, or whatever forecasts or milestones you're putting into your deck and in front of investors. If you can meet those milestones earlier or exceed those forecasts, it's just going to help you with this investment as well as follow-on investments.
So let me pivot real quick and ask you, like one of the big topics for every founder is valuation, and so valuation always comes up as a tough topic. What are really the best ways for, let's say, a founder to support their perspective on valuation? Especially considering like how challenging the market is, because this is the problem right now, is that because of the challenges in the market, valuations are just getting squeezed.
They are getting squeezed. I think to the extent that you can access some information on other transactions, even if they're somewhat anecdotal, having a command of other deals that have been funded, and be realistic. Don't hold out for some magical valuation that is unlikely to materialize, right? Because it's just not going to serve you well. But I think looking at time to commercialization, how much money you need to get to commercialization, how much you've achieved so far. If you've already are a little bit beyond seed, you can certainly look at how much capital's been put into the company, what you've achieved with it, and now, how you're positioned against others in the market, if there's anybody that is remotely comparable to what you're doing. And just enough data points to let investors know you've really thought about that. You just didn't pick a number out of the air, that, oh yeah, my company is worth 10 million now. So I think as much data as you can put together to justify your position, the better off you are. In fact, we work with companies before we take them to market on doing just that. We kind of ask them their valuation expectations, and then we kind of go from there.
Got it. Yeah, and by the way, for the audience who's listening and driving right now, if you want to learn more about Colleen's current company, US Capital, you can just go to uscapital.com. Quick question for you, Colleen. So, one of the other topics I wanted to ask you about is, even though capital is tough to come by these days, it's still technically a commodity, So that being said, I always feel that it's really important to be careful about who you take money from, to put it very bluntly. You gotta be careful about who you take money from. So like beyond the terms, like what are the qualities a founder, an entrepreneur should look for in an investor when it comes to a long-term relationship? Which I think even from a seed or Series A standpoint, you should look at it as saying like, if I need to go back and get more money from this person, right? What do you look for?
For me, and in my career, I've taken money I've regretted, and I've taken money that was absolutely the right fit.
Can we start with the money you regretted? I think that's always, everyone wants to talk about the good stuff. Let's talk about the terrible stuff. The money you regretted, why did you regret it?
Because there was no subject matter expertise. It was the investors first dipping their toe in the water of healthcare. And it was just not a good situation. Just didn't really understand the regulatory environment, didn't really understand the difficulty you have sometimes getting into hospital systems, what it takes, so I think that an investor that is so far removed from the industry you're in, you really got to think twice about that if they're going to be your principal investor early on, right? Later stage, when you are looking for pure financial investors to complement the investors you've already got on board that are, at least knowledgeable about the industry, that's fine. But the early investors, I think, have to have enough industry knowledge that you can actually connect with them and communicate well, and they understand what you're up against.
It's funny. I completely agree with you. I think it's funny you mentioned that, because I remember just 2 weeks ago, the interesting thing about my show is that I have investors on, I have founders on, and sometimes like I'm connected to both. And so there was an investor who had invested in a company that I know the founder and the company really well. And he sent me a message saying like, man, why aren't they selling these things left and right? And like, this thing makes so much sense. And I had to call him and say, hey, look, I don't know if you understand this, but they're doing everything they should. And they're actually on really good track. They're getting really good momentum. And I think part of the reason why is that this investor has investments in other sectors.
Yeah.
And I was like, you need to put healthcare in you need to forget about how you're looking at every other sector and put healthcare in a different space. It's very different, you know? And I think that's important because, like, anyway, that founder should send me like a fruit basket, because had I not called that investor, that guy would have been on his ass, like bugging him constantly about this. And, you know, as a founder, like most entrepreneurs don't want to push back to their investor and say, well, this is healthcare, it's more difficult. They got to come up with other excuses, and you just don't want to deal with that.
Yeah, but you know, I think that's the other thing that you learn when you get a little bit of experience behind you is, you know, you have to push back on investors at times, right? They aren't going to have all of the answers all of the time.
What, Colleen, in your entrepreneurial life, what was the hardest you ever pushed back on an investor on? Give me the dirty details of that.
I think pushing back on just an idea that, well, you know, you're located in California. Why don't you just focus on customers in California? And it was like, well, okay, you know, we need to think about where the majority of procedures are done with the products that we're trying to sell. And so, you know, that was a really heated exchange that, you know, like, why are you selling products in Florida? Well, because that's where they have some of the biggest need and are most open to adopting new products. So that one, you know, I think was went on for, you know, quite some time, but we eventually prevailed.
I love it. I love it. You know, in some of your in our conversation, you had mentioned it earlier that, you know, this sort of importance that there's going to be a lot of scrutiny on the financial model that you come up with. And, you know, investors these days, they want, let's say, like interactive Excel versions of that.
Yep.
In your opinion, like what makes a financial model, let's say well structured, you know, from an investor's perspective, and what are the most common areas that they like to focus on?
Well, I think that even for the management team, before it ever gets in an investor's hand, being able to do what if scenarios and variables that, you know, can be either conservative or middle of the road or even optimistic, but being able to run those variables through the model and have it really populate all the way through. That you don't really have to do a lot of heavy lifting if you want to change some assumptions. So the way it's constructed, as you said, these days, there's lots of tools out there to use where you can construct a financial model. But I think the underlying assumptions have to be articulated well. And as you said, you can get to those assumptions. There's lots of data out there, but just make sure you articulate, you know, somewhere in your model, have a page that talks about, hey, here are the underlying assumptions. And if you want to change these, you can change them right here. And you can have that populate through the whole model. And I think the companies that are able to put that type of financial model in investors' hands, I mean, they're making a great impression from that, you know, from that point forward, that they've really thought through this. And when they say they need, you know, $6 million, they need $6 million, and this is why.
Yeah. Look, kind of dive deeper on that financial model. One area that is big in our industry for very good reasons is intellectual property. So it's, you know, critically important. And, you know, you come from the world of orthopedics, very important there. But this is a place I feel like a lot of founders spend more money than they have to. What level of, let's say, IP protection is generally expected by investors at different stages? And like, how much emphasis do they usually place on, say, let's say freedom to operate?
You know, I think it's going to vary by investor, but, you know, freedom to operate opinions, a formal opinion, is really pricey to get that. And, you know, depending on how complex your product is and how many patents, you know, might be in the universe for that product type, I mean, that can be hundreds of thousands of dollars.
Right.
I think, you know, I think having
that's your friends and family round right there.
Yeah, no, it is. I think having a well thought out IP pathway is important. And certainly having a good patent counsel is important. And you can actually do a lot without a freedom to operate, you can create a fair amount of confidence in investors if you've got a good IP counsel, you've done a good job of identifying patents and articulating the claims. And, there'll be, I've found that most investors that are going to write a big check are going to want to talk to that IP counsel.
Right. And again, this kind of goes down this like winding rows of like expensive, like you start with IP and then you're going to get to legal, and like given the expense of, let's say, formal legal opinions on IP, how do investors evaluate a startup's IP claims and strategy? Like, do you think it's worth having a reputable IP law firm handling this at some point? Like, when should that happen? Because I feel like there's two worlds. There's the world of, I'm going to use XYZ like patent domain, to search patents. There's a lot of interesting AI based IP patent products out there. And then I have like a law firm that specializes in this. Like, at what point does it make sense to go to the like more expensive IP firm?
I think you can do the early research on your product and IP, using all those tools you mentioned. But I think before you go too far down the road at all, you're really going to have to start spending money on a reputable IP law firm. And that's probably, in the seed stage, not pre-seed. I would say not pre-seed, but I'd say somewhere in the seed stage, you really got to, invest in that resource.
What do you think? What's your take on another alternative form of capital would be like state-backed venture capitalists or grants? As a source of, let's say, early cash and support. What do you think about those?
I think those are excellent things. I think you can sources of capital to pursue. Certainly, there's certain universities around the country and cities and states around the country that will invest in startups that are in their state or their locality. I think there's many universities in, I don't know about all states, but certainly there's some very active ones. I do think that grants are always a good source. I know that's gotten a little bit shaky now, in terms of some of the changes that are happening with the grant system, from for instance, Department of Defense and NIH and those types of grants. But there are individuals and small companies that can help you with grant writing. Because there is a skill set to that. So, and they're usually not very expensive. I mean, they're pretty reasonable.
Yeah. And I think the most important thing is, for founders, I want them to sort of listen to this and understand, like, aside from the preparation of being able to have conviction, pitch well, and I think a lot of that conviction and confidence comes from the preparation of having the right financial modeling, framing the problem the correct way. And I think something that I mentioned this on panel at LLSI, which is there's a lot of people who I would say are like Sherpas, right? Because we've gone through this mountain multiple times. For you on the fundraising and investment side, my side is the marketing side. And I think that the way our ecosystem works is that we would rather, like, I have a business, I want, to grow it and take on more clients, but I would rather a founder come to me and say, hey, look, like, I can't afford you right now. Can I just get on a call and just get your feedback? I'd rather do that and do pro bono work and put them on the right path versus them not asking for the help and then they go down the wrong path and it becomes a much more expensive problem to solve later, or they don't raise money at all,
Yeah. No, I think that's true. I talk to a lot of people that I tell them, you're a little too early stage for us, but have you thought about reaching out to, various groups for some assistance that are maybe either incubators or angel groups. But, again, it's building a relationship where hopefully they'll be successful and maybe there'll be something in the future to collaborate with on.
Yeah. And, speaking of, let's say, different stages, when you match the investor to the company's, let's say, stage, like how do you think about pitch and the strategy around the pitch differing between, let's say, targeting, say, angels and high net worth individuals versus institutional investors and VC?
Well, I think if you're really targeting the angel networks, and including high net worth investors, I think you really have to be able to communicate okay, this is how much I need now. Here's what I'm going to accomplish with it. And here's how I'm going to get my next round done and where I'm going to target those type of investors. And, really think about the dilution that from the beginning, how much are you going to dilute the company with the early angel round? What type of, again, raising the right amount, that maybe your Series A is got to be less than, just the only capital you'll ever need, because you've got to be cognizant of dilution. So I think that's the other thing to keep in mind as you move through these stages, that, in the early stage with the angels, you're going to, demonstrate to them that you're aware of this. You want to protect their interests. You're not going to overly dilute them. And I think when you're talking with VCs and maybe family offices, which we've had a lot of success with family offices during this period of scarce capital, but you really want to be able to manage through the dilution situations you're going to encounter at every round. And because all the investors want to know that you're aware of that you're not going to raise more than you need. You're going to accomplish what you say you're going to accomplish. The valuation is going to go up. So when you're out there talking to VCs for, a much larger round, you've really got a valuation to support it. And you've accomplished enough that you can support the valuation.
Yeah, that makes complete sense. And Colleen, I want to thank you so much for coming on the show and sharing a lot of this insight and value. And again, for those who are interested, just go to uscapital.com. Colleen's also active on LinkedIn. But Colleen, I got one last question for you, which is we covered a gamut of topics. You had like one piece of advice you would give entrepreneurs, what would that be? And one, let's call it, I don't want to call it a watch out, but like one thing to just avoid. What would be the one piece of advice you would give them? And what would be one thing that's like, hey, just be careful about X?
So the one piece of advice I would say is don't wait too long to start your capital raise, because it's going to take longer than you think. Make sure you have a budget for that capital raise, because it's not going to be free. I think the companies that are successful go to conferences like LSI. You have to raise your visibility. You have to, be on social media. Just make sure that you are aware of your company's profile publicly. And I think that's, going to serve companies well that are in the capital raise market. And I think the thing to avoid would be don't spend the company off a cliff. Have enough runway when you go out to the capital market to understand, this is how much runway I have, and have a backup plan if you need to change your burn rate, because it's unpredictable out there as to how long it's going to take.
I love it. Colleen, thank you so much for coming on the show. If you're listening to this episode, you're an entrepreneur, do us a favor, send this off to another entrepreneur. I think the best part about this ecosystem is that we're always looking to help each other. Forward this on to another entrepreneur. If you're an investor, please e-blast this out to your portfolio companies. I think they'll benefit a lot from it. And as always, be sure to subscribe, give us 5 stars. And as always, I'm your host, Omar Khateeb. We'll see you all next time. Thanks for checking out this episode. If you want to do me a big favor and join so many other people who have helped grow this podcast, take a second and look below. If you're on Apple, give us 5 stars and write a short review. If you're on Spotify, just give us 5 stars. And if you're on YouTube, hit the like button. And most importantly, if you can, subscribe. We release so many different episodes that you may miss. Be sure to subscribe and turn your notifications on. You get extra points with me if you subscribe across all 3 channels. Thank you so much. And if you felt like this episode helped you, send this to somebody who would really enjoy and appreciate it. Share and spread the love. We'll see you all next time.